Hi, this is Attila Yeşilada, broadcasting for Real Turkey channel. It is 1:30 a.m. Friday in Istanbul. Today I want to talk about the rate hike by Central Bank of Turkey, which was completely unexpected. In fact, I wanted to shoot this video right after the rate hike. I couldn't believe my eyes. I mean, I'm still pinching myself to see whether it really happened. It did happen, right? It did happen. Central Bank of Turkey hiked interest rates by 500 basis points 10 days before local elections. Is Erdogan still Turkey's president? By the way, I should get rid of this glasses. Look, I'm a fairly broad-minded guy. I suspend disbelief very easily. I believe in space aliens. I believe in faster than light travel. I don't believe in zombies and vampires. That's impossible. But I do believe in werewolves. They exist. I have first-hand experience. Nevertheless, it's very difficult for me to believe why central bank raised interest rates under these conditions. Of course, it was necessary. It had to be done. But Erdogan being Erdogan, in the past, he has rejected pleas by central bank governors to raise interest rates and instead took shortcuts like forbidding free flow of capital and currency transactions to stop the pressure on the currency and to delay the interest rate hikes. So this is really just like, a very once in a blue moon event that requires immediate analysis. The message of this video is very simple. The central bank rate hike reshapes not only Turkish economy, but Turkish politics as well. It tells a lot about what Erdogan intends to do about the economic stabilization program after the local elections. Let's start by putting things into context. Why central bank raised interest rates and why is it important for the economy? And then talk about the Turkish economic policy orientation after the local elections, which will be held on 31st of March. And three, on the political implications of the central bank rate hike. Currently, official CPI inflation in Turkey is 66%. According to official projections of the central bank itself, it is going to accelerate to roughly 73 to 75% within the next 6 months of the year, and then it will decelerate, hopefully. As you know, when an economy is overheated, and as is the case in Turkey, budget deficits are expanding, the economy would not trigger disinflation by itself. There has to be some kind of policy intervention, either tighter monetary policy or tighter fiscal policy, or a combination of both, preferably, to disinflate the economy. But this wasn't the case in Turkey. The central bank has set the policy rate at 45% per annum and clearly stated in his recent statements that this was enough, that they would wait for the accumulated effects of interest rate hikes to see that inflation is coming down. And in their view, the current tightness of the monetary policy was sufficient. But clearly that didn't convince the people of Turkey, and demand for foreign currency has begun to increase rapidly. To a large extent, this is because there has been endless speculation on social media platforms like YouTube that after the local elections, Mehmet Şimşek, the current economy czar, will be sacked, and Erdogan will revert to his unorthodox policy choices, which are characterized by the motto that the lower the interest rates, the lower inflation. Yes, he is the only human being on earth that believes that. Maybe he's an alien, I don't know. But clearly, the fear of going to economic policies, which characterized Turkish policymaking scene since 2016, essentially, until the last general elections in May 2023, was a huge fear. This episode has also been characterized by periodic outbursts of Turkish lira devaluation. Understandably, a lot of the locals migrated from Turkish lira assets to hard currency assets, and from financial assets to real assets, like, houses, real estate investment, even second-hand cars. I mean, when you have a country where inflation is officially 66%, perceived inflation probably 10, 15 percentage points higher, and where the highest TL deposit rate one can get is at most 55%. All of these figures in simple annualized. Clearly, it doesn't make sense to remain invested in Turkish lira assets. Inflation erodes the principal, and the interest rate compensation is not enough for that. So there has been this steady flow of savings into hard currency assets. The central bank at that point had enough FX reserves to control the currency and to avert a shock devaluation. But this couldn't go on forever. As long as interest rates were too low or no other measures were taken to slow inflation, the demand for FX assets would continue. And at some point, central bank will run out of FX reserves, and Turkey would have another excruciating episode of Turkish lira depreciation. This is why I think the central bank hiked rates. Clearly, a 500 basis point rate hike with an option to increase it at will by another 300 basis points is a good start, but not sufficient to stop the inflationary pressures in this country. It may slow down dollarization, but it will certainly not reverse it. Nevertheless, it's a beginning. And the fact that it's been undertaken right before March 31st local elections, which are turning out to be much more competitive than President Erdogan imagined, means that this is a landmark, that we have crossed the threshold. We have crossed Rubicon, and it's important to see where we're going from here. Economically, Turkey needs much higher interest rates. It is difficult to pinpoint what the optimal interest rate would be to achieve the kind of disinflation which would take Turkey from the current CPI of 66% to single digits in 2026. But a good starting point would be a policy rate of 60%. It is currently 50%. And keep the tight monetary stance for a long time until inflationary expectations are completely squeezed out of the economy. Two, even that might not be enough because Turkish budget deficits are soaring. I admit part of it is because of earthquake reconstruction, but also the underlying fiscal deficit is very large. And I think at this point it is understated simply because Erdogan, once again, as he had done prior to the 2023 May local general elections, has promised a lot of fiscal spending, which will kick in after the elections. As you know, when budget deficits expand, primary budget deficits, but I don't want to get technical, it increases domestic demand and adds to inflationary pressures. So Turkey needs to hike rates further, and Mr. Mehmet Şimşek needs to do something to bring the budget deficit under control. Even those two things are not enough to stabilize the economy. We need structural reforms. That means new measures that would improve the flexibility of aggregate supply, make Turkish economy more efficient, more productive, which would mean that any increase in GDP would result in lower current account deficits and in lower inflation. I'm not saying all of these things will happen, but they need to be done. Just because the central bank hiked rates 500 basis points today doesn't mean our travails are over. There is going to be a lot more suffering on the horizon. But let's move to the political aspect. The very stark fact that Mr. Erdogan, who has always been anti-interest rates for a variety of reasons, have taken that bold decision means that now we can have hope that also fiscal deficits will be contained and perhaps eventually structural reforms will be instituted. In fact, allow me to go out of my way to say that I would not be surprised if after local elections or sometime in the fall of 2024, IMF is called in, not necessarily for a standby loan, but to provide technical assistance as to how to deepen and advance this economic stabilization program. Why has Mr. Erdogan done that? I don't know, honestly, but he has been, from an economic policy perspective, he has been on a journey of redemption to atone for his mistakes of the last 7 years. It may be because he has finally gotten rid of his lunatic fringe advisors who kept telling him we should cut interest rates further to lower inflation and control the exchange rate by other means than the market mechanism to stop the bleeding of the Turkish lira, and have surrounded himself with wiser people. Mehmet Şimşek, perhaps his new foreign minister and new chief of spy agency. Also his second son-in-law, Mr. Berat Albayraktar, who is in charge of Turkey's military drone industry. It's not clear why he changed. He might, as he said, actually be planning to retire, and he might have wanted to leave a very good legacy, a solid economy, or paved the way for his handpicked successor to be elected without any economic concerns marring this election process. But nevertheless, in my view, he has done enough for me to believe that Turkey's economic stabilization program will be intact after the elections, that Mehmet Şimşek and the central bank governor, Mr. Fatih Karahan, will retain their post and they will be allowed to do whatever it takes to stabilize the Turkish economy. Can look at my videos below. A week ago, I still believe that if Mr. Erdogan lost local elections, which is defined by the main opposition party and his candidate, current incumbent Ekrem İmamoğlu, keeping the mayorship of Istanbul, he might look for a scapegoat and fire Mehmet Şimşek. I don't think that's in the cards anymore. He has trust in Mehmet Şimşek, and he will give him and Fatih Karahan, of course, the authority to pursue a more comprehensive and effective austerity program. This is why I started this video by saying this rate hike goes beyond stabilizing the currency and helping lower inflationary pressures. It reshapes economic policy comprehensively and introduces a new narrative in Turkish politics. Sane economic policies may be the order of the day from now on. Will Turkey reap the benefits of that? In many ways, yes. From the press articles as well as from my private conversations with global fund managers, they were extremely interested in Turkey's story. But having been burned by Mr. Erdogan several times in the past by unexpected policy reversals, they were very reluctant to dip their toes in Turkish financial markets. Many have expressed the view in the Western press as well as in our private conversations that they want to wait to see and make sure that Erdogan doesn't change his views once again. I think these doubts are now dispelled to a large extent, and Turkey will see the kind of financial inflows that help stabilize the currency as well as build up central bank reserves. It could go even further than that. It is now quite conceivable that Mr. Mehmet Şimşek's ultimate goal of moving from an arbitrary economic policy regime to a rule-based economic policy regime could become a reality. In that case, Turkey will get what she really needs, which is high-quality foreign direct investment. That's investment into our factories, bringing in technology, buying Turkish companies to make them more productive and more profitable. This will not only improve our current account deficit situation, but will also improve productivity in the economy and allow Turkey to achieve a higher growth rate. So this is really one of the most significant events, in my view, that has taken place in Turkish economics since the reappointment of Mehmet Şimşek. And today I'm much more constructive over Turkish economy and economic policy than before the central bank rate hike. I want to thank you for watching this Real Turkey channel video. Please subscribe or share it with your friends who are Turkey enthusiasts. And I'm grateful for all of your comments. This is Atilla Yeşilada saying goodbye from Istanbul.